So we are going to talk about today the tools of monetary policy. All right. And so as you saw in the video before from Crash Course, monetary policy is carried out by our friends over at the Federal Reserve. All right. And the Federal Reserve is essentially the nation's central bank. And if you want more information on that, talk to your friends who've taken AP US history. There's a lot of fun, interesting stuff in regards to the history of the Federal Reserve. But what I want to talk about is how the Federal Reserve does its job, right? And it has two jobs, right? It has a mandate to control prices, and it has a mandate to maximize employment. Maximize employment. Right, and so the question then becomes, how do they do that? Well, there are three primary tools that we're going to talk about here for this course in terms of how they do that. So what it's all about is, it is all about influencing this graph, right? The money market graph. So this is a graph we've seen before, and you have it on your graphs document. But what it is articulating, it is the total demand and the total supply of money in an economy with your nominal interest rate, aka your price per dollar, on the y-axis and the quantity on the x-axis. So what the Federal Reserve is doing is it's attempting to manipulate our real GDP equation by targeting investment and interest-based consumption. So things like credit cards, home loans, car loans, student loans, things like that. All right. So over here we're targeting consumers. Over here we're targeting businesses primarily. All right. And so what they're trying to do is they're trying to affect the amount of loans banks make. And because we saw from last class, the more loans a bank makes, the more money deposits, more money is created, then the more deposits that are created, the total overall money supply will increase. All right, so what they're trying to do is they're trying to get money out of a bank's excess reserves. They're trying to get money into a bank's excess reserves, because remember, excess reserves are the funds that are loanable to consumers. All right. So you have your excess reserves, and then you have the required reserves, which are money that is not loanable. But you also have money that is not in either category, that's in your, let's say, securities or treasuries. Right? So banks can hold bonds just as you and I can. So they're trying to get money that may be here, up into here, and then from here out to consumers. Right? Because if there's more money in excess reserves, banks are going to make more loans. If more loans go out, then the money multiplier impact hits, then the money supply goes up. And the nominal interest rate drops, which does what? Increases the quantity demanded of money. And if there's more quantity demanded of money in terms of loans, then that's going to cause this to go up and this to go up. Right? So when we're talking about what the Fed has been doing over the last couple months here in the United States in 2020, that's what they've been doing, dropping interest rates to near zero. And the way they're doing that is, I'm going to show you how they do that. But that's what they're targeting. They're targeting increases here and increases here. All right. Now, if we were in another situation, if we were in a situation that looked more like this, well, that is an inflationary gap. We need to cool the economy down. We need to drag this sucker back. We need to do the opposite. So you're going to get money out of here so that it stops going to consumers, get it into the required reserves, or move it into the treasuries, and then consumers aren't borrowing as much, businesses aren't borrowing as much, the economy cools down, and then we drag back our aggregate demand curve. But primarily since the 1970s, this has been what our target has been. So let's talk about how we do that. First tool they use is something called the reserve requirement. So we talked about the reserve requirement previously, but the reserve requirement is the percentage of each deposit that the Federal Reserve requires the bank to keep on hand and put aside for a rainy day. All right, so if the reserve requirement is 0.2, so that means for every $100 deposit, 20 of that goes into required reserves, and the other 80 of it can be loaned out, and that's in your excess reserves, right? Because remember, that's how banks make money. They take your money, they credit it to you, right? They write down, let's say, you know, Matt Beatty is owed $100, but that $100 doesn't sit there, right? That $100 then gets, let's say 80 of it gets loaned to Kira, and then Kira is credited $80, and then a percentage of that is held and the rest goes out, right? So it's really just a credit on your account, not actually your money sitting in the bank. So, but by changing this number, they can increase or decrease the amount that is in the required and then is in the excess, right? So if instead of a 0.2 reserve requirement, they lowered that to 0.1, and we still have that $100 deposit, well, that means now only $10 goes into the required reserves, and then $90 goes into the excess reserves, right? So if we look at this and we see how much new money this could create, well, 1 over 0.2 is 5. 1 over 0.1 is 10, right? So that's going to create a much larger impact here, and with the $90 in the excess reserves, right? So that lowering of the reserve requirement is going to have a larger impact, right? So by lowering the reserve requirement, the Fed can immediately increase the lending capacity of a bank, right? It moves money that was otherwise frozen and puts it into the excess reserves. Then the banks can loan that out. It creates new deposits, and it lowers the interest rate, right? With the target goal of being what's happening here, increases in consumption and increases in investment. Now, the reserve requirement, if I'm not mistaken, you can Google fact check me on this, in the real world, outside of the College Board AP Theory course, has not been changed since, I want to say, 1998. So the reserve requirement has kind of fallen out of fashion as a tool of monetary policy. The discount rate is another tool we can use, right? So if we think about this, remember, if you have, let's say, we'll go through this in more detail next week, but an assets and liabilities table. So assets are things you own, liabilities are things you owe, right? So let's say over here you have your required reserves. Let's say you have $20 in your required reserves, and in your excess reserves you have $80. So that means you have a reserve requirement of 20%. And then you have total deposits in your bank, otherwise known as checkable deposits, that you owe to people. You owe $100, right? So when that deposit comes in, 20 of it is here, and the rest can sit here. Now that $80, if it sits there for a long period of time, you're not gaining any, the bank is not making any money off of that, right? Because a bank is profit driven. So they need to make this money go out. They need to loan that money out to make any money off of your deposit. All right. So they have an incentive to keep as little extra on hand as possible, right? So they are not required to loan all 80 of this out. They most likely will because of this profit incentive, right? Lending out 80 is better than lending out 75 or 70. Now, if they get caught short though, right? Let's say they lend all this 80 out. So now their balance sheet looks like this. All right, and they still have that 100 over here. And let's say, Smallwood walks in and tries to clear her whole account of, let's say, $200, and they are now a little short, what are they going to do? They can borrow money to make up for that shortfall. Now, who do they borrow it from? There's two places. They can borrow it from other banks, and that's a common occurrence. Right? They can, PNC can call TD and be like, I need a 24-hour short-term loan of $200,000, and the bank, TD Bank, will charge, just like they charge you, an interest rate. That is going to be called the federal funds rate, and we'll talk about that at the end. But if, let's say, if the banks can't do that, if the banks aren't willing to loan, and then PNC is going, oh, I'm screwed here, they can turn to the Federal Reserve. And the Fed has been called the lender of last resort. So what the Fed will do is say, sure, I'll lend you that money with interest, right? And that interest rate is the discount rate. Now, how can they use this as a tool of monetary policy? Well, if the Fed is targeting economic growth, right? If the Fed is targeting an expansion in, oh gosh, I'm so sorry. If the Fed is targeting an expansion in the money supply, right? They want to see this. Then they will keep the discount rate, or they will lower the discount rate. Because if the price that they are going to charge banks to borrow from them is super, 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 super low, then the opportunity cost of borrowing from them is very low as well. So then that's going to create an incentive for banks to say, you know what, even if I'm caught below the reserve requirement, it's going to cost me like a penny to borrow that money from the Fed. So screw it. I have $80 in excess reserves. I'm loaning it all out. Right? That way you maximize the deposit creation. Right? Because we have 1 over 0.2 would be the money multiplier in this scenario. So 1 over 0.2, which is 5. Right? So 8 times 5 is 40. So you'd have $400 in new deposits if you lent out all 80 of this. So that's what the Fed wants to see. The Fed wants to maximize deposit creation by limiting the costs for the banks if the banks fall under the reserve requirement. And that's what the discount rate is there for. You can raise or lower it to incentivize or disincentivize. Now again, this is still like a third tier tool. The Fed can do this, but in terms of sizable impact, it is not the tool that has the largest sizable impact. The tool that has the largest sizable impact and is the most used tool is something called open market operations. And what open market operations is the Federal Reserve buying and selling government bonds, aka government debt, on the secondary market. Now, let's talk about how that works. So, a bond is a promissory note, right? Whether it is a $25 bond that your grandmother bought for you on your 15th birthday, or if it's a $1 million, billion dollar, $500 million bond that a government, a bank, an institution holds, right? So if we go back to our assets and liabilities table, assets are things you own, liabilities are things you owe. So you have required reserves. Let's say we have $20 in required reserves. And excess reserves, we have 70. We have a total demand deposits, meaning money that is owed, of $100. And let's say we have a reserve requirement for this bank of 0.2. So now we have 20 in required, which is what we need. We have 70 in excess, but we're missing 10. That last $10 that the bank has sometimes goes into securities, aka treasuries, aka bonds. Because just like you, banks will sometimes put money away for a rainy day, kind of like what's happening right now, right? If banks were smart over the last decade, they've been squirreling some of their assets away so that they didn't get caught with their pants down again, like they did after the 2007-2008 recession. So in my little scenario here, they are holding $10 in securities. Now this money here in securities cannot be lent out to Tom, Dick, or Harry. Only the money that's here, right? So if the Fed is looking to increase the money supply, to lower the nominal interest rate, to increase investment, and to increase interest-based consumption, they want to get this money out of there and into here so that it's out and flowing through the economy, right? So now the question becomes, how do they do that? The Fed cannot just mandate, hey, give me your securities and I'll give you cash for it. They have to create incentives. So what they will do is they will essentially, the Fed will buy the bonds back from the banks. And they will do that by incentivizing it by lowering the return on the investment. All right, so the Treasury bonds are typically low risk, low reward investments, right? Very unlikely that the federal government is not going to be able to pay its dues in 20, 30 years, so people will invest. So it's not very risky, so the interest rate you get on a bond is very low. To incentivize banks to give up their bonds, they will lower the return rate, the yield rate. Because let's say if the return, and again, I'm making these numbers up, but let's say the return on this $10 bond was 2%. If they lower that yield to 0.5%, then the banks are going, I'm gaining 0.5% on this in 10 years. That's a really low return. That's probably not even going to account for inflation. I can make more money now by loaning that $10 out to McKenna and Bingo Bango, right? So by lowering the yield, the banks go, this money is just sitting there essentially. So I need to, the bank, they will allow the Fed to buy the security from them, which then makes this a zero, which then that $10 gets shifted up into here. And so now they have $80 in excess reserves, which can be loaned out, which then will increase the size of the money supply, which will lower the interest rate, which will increase investment and increase consumption, which will increase your GDP. All right. So if you buy bonds, the Fed is buying bonds from the public. That is increasing the excess reserves, which increases loans, which increases money supply, which drives the interest rate down, which drives real GDP up. All right. So one last thing on that component is, so when the Fed buys the bonds, the bond demand is rising, right? And so when we know when the demand for something goes up, the price goes up, right? That increases the money supply, it lowers interest rates. When the Fed sells bonds, right, if we're dealing with inflation, they need to bring the economy back down. They're selling bonds. So in that case, the supply is increasing. Look what happens to the price. Price goes down. That decreases the money supply, and it raises the interest rates. Now, what they're really doing here is they are targeting something called the federal funds rate. And so 2 slides ago, I talked about what happens when a bank doesn't have enough money in its required reserves. Where can it turn? Well, the lender of last resort is the Fed, but their first resort are other banks, right? So to incentivize other banks to loan to other banks, that interest rate is called the federal funds rate, right? So if PNC borrows from TD Bank, the interest rate that that bank charges the other is the federal funds rate. So by using open market operations, the Fed is trying to encourage the federal funds rate to decrease. Because if the federal funds rate is decreasing, so let's say a bank before any open market operations, let's say TD would charge 5% for an overnight loan to PNC. Maybe that's a bit steep for PNC, so PNC is going to hold money in their excess reserves and not loan out all the money they have because they're worried about having to pay that 5%. It's going to dampen down deposit creation. It's going to dampen down the growth of the money supply, and that's not what the Fed wants. So if the Fed then does some open market operations and buys bonds, then TD is going to have more money, more capital. They're going to be more liquid, and so maybe instead of 5%, now they're willing to charge 3%. Well, now 3% PNC goes, now that's I can do that. 3% is cheap. Then they're going to loan out all excess reserves, maximize deposit creation, maximize loans, increase money supply, decrease interest rates, increase GDP. All right. And so the OMO, open market operations, are nudging the federal funds rate down because the federal funds rate is not something that the Fed can control because we are a free market economy. Okay. So a lower federal funds rate may lead to more interbank lending. A bank with more excess reserves can lend to another bank who needs excess reserves, allowing them to create more loans. Excess reserves go up, loans go up, money supply goes up, interest rate down, and that is the whole concept of open market operations. All right, so I'm going to stop there because I'm approaching 22 minutes, and this is probably the most difficult lesson we have to go through, so I want you to watch it, take notes, come back to this lesson, particularly for the assignments I'm about to give you in response to this. Okay, thank you.